A geopolitical headline can travel through markets in a matter of minutes. The first move may appear in oil, the next may show up in inflation expectations. Then treasury yields change, technology stocks react, and crowded trades can move sharply as investors reposition. But a market reaction is not the same thing as proof. It does not prove that one headline caused every move. It does not prove that institutions were distributing shares, and it certainly does not tell us what prices must do next.
The useful question is more practical. What is the transmission mechanism? If investors believe a geopolitical development reduces the chance of an energy disruption, they may demand less compensation for oil supply risk. Lower expected oil prices can reduce some inflation concerns. Lower inflation expectations can affect treasury yields. Changes in yields can matter for assets whose valuations depend heavily on cash flows far in the future, including many technology stocks. That is a chain of plausible reactions. Each link has conditions. Each link can fail.
In this lesson, we will trace that chain, then separate it from gold, crypto, short covering, and 5 caution signals that can appear when momentum becomes fragile. By the end, you should be able to do 5 things. First, identify what a headline changes directly and what it changes only through expectations. Second, trace a possible path from geopolitical news to oil, inflation expectations, treasury yields, and liquidity-sensitive assets. Third, recognize why gold and crypto may respond differently from technology stocks, even when all 3 are described casually as risk assets. Fourth, distinguish short covering from fresh buying. And fifth, treat distribution signals as cautionary observations rather than proof of institutional intent.
The discipline is to keep 3 categories separate. There is the event itself, there is the market's interpretation of the event, and there is our explanation after the fact. The event may be reported but not independently verified. The interpretation can change quickly. The explanation can be plausible without being certain.
Our example uses a development described in the August 2nd source transcript, a reported pause in military action involving Iran. We are treating that as a source assertion, not as an independently verified fact. The point is not to decide whether the report was correct. The point is to learn how a market might process a report like that and where the reasoning becomes uncertain.